Okay, now that we've covered the history of the platform and the initial design requirements, let's take a quick tour. When you first enter the reporting, the interface you're presented with is very clean and simple, and it looks very similar to what you would see if you use the available iPad app to log in. So let's select a client and then select a day. Every day you have two report binders available. The summary report is the one that you're likely to spend most of your time on. But if you need to drill further down into the numbers or to see the charts in a different format, that's what the detail report is for. In addition, if you want to drill all the way down to the position level, all the cycle detail logs are available that show that information. So if we go into the summary report, the second page of the summary report is the skipped instrument listing. The purpose of this listing is to alert you to any instruments in your portfolio that were not included in today's risk calculations, either because the instruments are not supported by the system or perhaps there were expiring options. In any event, before you view any risk analytics, the first stop is to see if anything was excluded. The first page of the analytics is a value at risk summary that's run across all the accounts combined. So on one page here, we're looking at the output from 32 value at risk scenarios on one page. This is helpful because you can see a broad range of outcomes. So in this case, we're looking at 4 different value at risk models. And for each value at risk model, we're looking at 2 different look back periods. And for each look back period, we're looking at 4 different confidence levels. So as a result of changing the parameters in the models, we end up with 32 scenarios on one page, which is much easier to assimilate than if this information was presented in tables or more detailed numbers. So the first page of the value at risk analysis is for all accounts, and then we cycle through each account individually. So this is long only, long short, the options portfolio is flat today, and precious metals. After value at risk begins the stress testing. There are 2 types of stress testing in this analysis. The first one are the ones that I call the non-index stress tests. This is where we stress the existing positions in terms of what happens if there are sudden spot moves up or down. What happens if volatility shifts suddenly? Perhaps a combination of spot moves and volatility. And then we can look at what would occur if there were multi-standard deviation moves in either direction. Again, just like value at risk, this is all fully configurable at the client level. And just as before, we start at all accounts and then we scroll through each of the other accounts individually. The last section shows the index-based stress tests. This is where we take the portfolio's positions and stress them using a shock to an external factor. In this case, what I've configured are shocks in gold prices up and down, shocks in oil prices up and down, or shocks to the stock market as a whole. So again, these configured scenarios show me a lot of information on one page. So in this case, these are the moves based on another 9/11 attack, or another October 87 crash, or a flash crash. This scenario shows the Geithner rally, which can be very relevant if somebody's trading from the short side or perhaps they're trading call spreads. So again, just like the other charts that we've seen earlier, all the information is presented on one page, much easier to assimilate. So let's do a drill down example just to see what supports these bars. So let's take a particularly scary one, and let's take cycle 172. This bar shows approximately a 12% drop if there's another 23% drop in the stock market, which would be similar to another Black Monday. So if we switch gears and go to the cycle detail report and scroll down to 172, let's make this a little bigger so it's easier to read. This information is available at the instrument level. So for example, if we take this particular stock as an example, as of the prior close, it was trading at about $84 a share. If there was another 23% drop in the SPX index, similar to Black Monday, that stock would be priced at approximately $63 or almost $64 a share, which would be an estimated $23,000 loss due to that one instrument alone. This analysis, of course, is repeated for all the instruments, and when you sum the instrument level stresses, you come up with the approximately 1.2 million loss, which is the 12% you saw on the bar earlier. So the power of what we're doing here is we're able to drill all the way down to the instrument level information from a high level chart. If there were options included in this portfolio, the deltas are also computed and available every day. So the delta, gamma, theta, and vega for every option would be available.